This is shocking. I'm your host, Steve Van Meter, and thanks for joining me today. In our lead story today, what's happening at Home Depot is outright terrifying and is going to send shockwaves through the entire retail sector. And wait till you see what's happening to this major retailer, because it means bad things are coming for every other retailer in this country. Plus, the unexpected is about to hit the Eurozone economy, and Beijing is now in full panic mode as the fiscal stimulus spigots get turned on as they hope to keep their housing market from crashing down. And we're also seeing renewed signs that U.S. consumer demand is outright crumbling, along with the Fed's expectations that they're going to hike rates. Plus, we have a sponsor for today's show, Avicanna. They're a Canadian international commercial stage biopharmaceutical company. You can find them on the TSX under AVCN and on the OTCQX under the symbol AVCNF. And you're going to want to watch this company because they've got a bunch of big news coming. And we're also want you to watch their stock price because we think it could move as much as 34% to the upside. It's sitting on its 2-year volume profile under a major accumulation pattern. You're not going to want to miss this. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Reuters, where we picked today's story up with a headline: Eurozone Q3 GDP shrinks, but employment rises. And that's the hope of a soft landing as you see the economy slow, but the labor market stay intact. Well, we've got bad news for the Eurozone. The unexpected, it's coming, and soon. The Eurozone economy contracted marginally quarter on quarter in the third quarter, a new estimate confirmed on Tuesday, underlying expectations of a technical recession if the fourth quarter turns out equally weak. But the key part, employment still rose, and so everyone's now excited that this might be just a technical recession, because look at the labor market. But wait till you see what's going on at Home Depot. You're going to see here in the U.S., there's not going to be anything like a technical recession. It's going to be far worse. But now let's make the case of what's going on in the Eurozone. Well, the unexpected is coming, and that means employment is going to decrease in a major way. And here you can see in this chart, looking at the U.S. data, we have the real gross domestic product. That's on the left side here, shown on the year-over-year rate of change against the 4-week moving average of initial claims. That showed in red. And anytime you see the economy starts to decelerate, what happens, there's usually a follow-up of rising initial claims. And you can see that repeated over and over throughout history. Here it is in the late 80s, early 90s, the dot-com bubble. And again, during the global financial crisis, we saw a little bit of that happen here just earlier this year. But what happened is GDP growth jumped, and that meant unemployment claims headed lower. What does that mean going forward, at least for the U.S.? Well, we know GDP growth is slowing, and of course, that in the Eurozone, if it's slowing, it also means that at some point, employers say, we can't keep these employees if we have no work. But one place that's looking for work in a big way, it's China, because Beijing is getting desperate in a major way. As China mulls $137 billion of new funds to aid their housing market, looking to inject cheap funds in phases would mark a big step up in Beijing's effort to boost the economy. We told you this was likely to happen at some point, and it was only a matter of time, because Beijing would eventually figure out that their entire banking sector is in jeopardy when the housing market goes, and they would come in and inject funds, and now they're starting to do it. Will it be enough? Well, probably not. The People's Bank of China would inject funds in phases through policy banks, with the money ultimately trickling down, well, at least with hope, to households for home purchases. But wait till you see what they're going to do. Officials are considering options, including the so-called pledge supplemental lending and special loans, adding that the government may take the first step as soon as this month, suggesting, as we have said, that the housing market in China is in far worse shape than anyone wants to admit, particularly Beijing. Dubbed some as helicopter money, well, that's usually what fiscal stimulus is. The PSL allows the central bank to provide low-cost funds through policy and commercial lenders to the developers of the shantytown renovation projects. Check this out. Developers then use the money to buy land from local governments, which in turn gives cash subsidies to households whose old homes were demolished so it can purchase newly built or existing apartments, driving up demand. Well, if there's one way you can make demand happen in a debt-based economy, it's to knock down people's homes and tell them, here's some cash, you gotta move. So this is an interesting move here, and it has a big specific reason, because I want you to see that China's giving money initially to the banks, and this is critical. But they're hoping, they don't really care as much if it gets down to the end consumer immediately. What they needed to do is get to the property developers, and in a big way. As state-owned developers such as China Resources Land were among the biggest beneficiaries from the previous expansion of affordable housing projects. And there you go, money flowing right back to the developers. And that's exactly what China is hoping here, is to stabilize the developers and all of a sudden see if consumer demand for housing comes back. Notably, the other effect of this PSL loans is it tends to drive housing inflation. And right now, we know that China's housing market is in that deflationary mode. When that happens, consumers don't want to buy. But if they start to see prices rising, what China's hoping is they're not going to have to do a whole lot more as they start to reignite the consumer into buying homes. Of course, what we're making the case is the global economy slowing too much to actually save China's economy. And sure enough, evidence of that as we head over to the U.S., where things get worse. As worst sales beat in years shows weakening U.S. consumer trends, this is a big problem, with 80% of the U.S. S&P 500 firms having reported. Less than half have beaten revenue estimates for the third quarter, the lowest share since the same period in 2019. Now, I want you to think back, to 2019. A lot of people don't really remember too much about it because the big thing happened into 2019 as we found out that COVID was spreading through China, and then all of a sudden it just took major fire across the world. In March of 2020, we know it hit the U.S. economy as everything got shut down here. But as we think back to what was really going on in 2019, and why this is so interesting is because the global economy was in a synchronized slowdown. And so here we're seeing that with 80% of the S&P reporting that less than half have beaten revenue estimates, again, the lowest share since the same period in 2019, giving us an ominous warning of where the global economy is headed. The pace of sales growth globally is also moderated to the lower end of their pre-pandemic ranges, again suggesting, as we've made the case, that the global economy is in a synchronized slowdown, heading into a synchronized recession, likely followed by a synchronized financial crisis centered around the banks, because it always is. A Bloomberg analysis of earning calls shows transcripts have weak demand is among the top trending phases in both the U.S. and Europe, with 20% of companies still to report. These mentions are already the second highest on record, and it should be with no surprise that we're seeing weak demand, because it should be obvious to policymakers, and that is very simple, is if demand goes down when consumers have less money to spend. We've been making the case that financial conditions are tight, and they're tightening even further, meaning there's less money in the economy. When there's less money, well, that means total compensation growth continues to slow, along with retail spending. And sure enough, this chart validates it. As we see total compensation in red, this is average hourly earnings multiplied by average weekly hours of production and non-supervisory employees against advanced retail sales. That's shown in blue, both on a year-over-year rate change. And lo and behold, you see a beautiful relationship where total compensation growth goes, retail sales eventually follows, telling us that these retailers and these major companies have everything to be concerned about, because the notion that we're going to see total compensation growth continue to rise here amid a global slowdown, well, that's not going to happen at all. And so we can predict now that retail sales are going to further decline, which makes it more interesting when we have to hear what Home Depot had to say, because their warning for what's coming for the U.S. economy is outright terrifying. But still, consumers are now still changing their pace. They still believe inflation's coming, but we're going to show you why they've got it wrong. As U.S. consumers trim inflation expectations and their outlook for finances remain mixed, so they still have their inflation expectations here is rising a little bit. And wait till you see what they're keyed around, because the exact opposite is actually happening. But what's notable here is we see in this headline, a larger share of consumers expect tighter credit conditions. And this is really key in a debt-based economy, because if consumers start to get the impression that banks are going to further tighten lending standards, they're not going to go out and try to borrow. They're just going to give up, and that means they're going to focus on paying down their debt. They're going to get keyed into thinking the economy is going to slow down and recess, that maybe their hours worked are going to get further cut, maybe even someone they know is going to lose their job. And this is going to be a concern, because when consumers start to believe that the economy is slowing, they cut their spending, and you start to get a feedback loop where less spending leads to less consumption, and next thing you know, you're back in a recession. The report showed consumers have mixed views about their ability to access credit and find work. And this is interesting because we validated this in last week when we looked at the initial claims data. What did we see in the continuing claims part of that report? Is that said that fewer people are able to find work when they're on unemployment, and that means when that happens, again, it all leads to reduction in spending. A smaller share of respondents reported finding it more challenging to access credit now than a year ago, but a larger share of people said they expected to see tighter credit conditions in a year, suggesting that things are going to get worse for the banks. Of course, we've noted that when the Fed inverts yield curves and money curves, well, that means banks want to lend less because they don't make any money lending. The big issue here is consumers are afraid that the banks are not going to raise their credit limits anymore, and that means an end to the American binge spending. And sure enough, if that happens, there goes retail sales. Well, if we take a look here, we have advanced retail sales continuing that theme in blue on a year-over-year rate of change against the net percentage of domestic banks tightening standards for credit card loans. That's shown in red. And anytime the red line's above that horizontal black line, what it means is on-net banks are not extending credit on credit cards as much. And when that happens, sure enough, notably, retail sales growth slows. You see that here during the dot-com bubble. How about the global financial crisis? When you tap out those credit cards and banks won't extend the limit, well, there goes retail sales as we saw during the global financial crisis. How about during the pandemic? Well, that was obvious until the government started handing out money, and we're seeing those signs again, which again is just an ominous sign for Home Depot, which is just something they're suggesting is coming, and that's going to have a major effect on every retailer in this country. As you think of what's been going on, what have all these retailers done? Well, they've hired a lot of people buying into this soft landing narrative, and what they're going to find out is people aren't coming. As for the jobs market, the perceived odds of losing a job in the next year rose by 0.3 percentage points to 12.5%, and the probability of finding a job after becoming unemployed rose slightly to 56.6%. Well, we know that number is going to actually go down in a big way, because since the survey, as we talked about with the initial claims report from last week, we saw more people on continued claims. We'll get the next report here on Thursday. If that continues to tick higher, it suggests that layoffs are going to surge here in a big way. The New York Fed monthly survey of consumer expectations showed households expect prices to rise more rapidly for gas and medical care. Expectations for how much the cost of rent and food will rise over the next year held steady at 9.1% and 5.6% respectively. So think about this. If consumers actually believe that prices are going to rise and their wages aren't, that means they're going to start cutting spending in every other way. Again, you talk about what's coming for U.S. retailers here. It's not a good sign. Again, they staffed up, they inventoried up, they need people to spend, and we're finding out they're not. But yet, inflation expectations are likely going to turn to the downside here in the near future. Here we see the Consumer Price Index against U.S. regular all formations gas price. That one in red, both shown on a year-over-year rate of change. And what we can note is that gas prices tend to lead the Consumer Price Index. And while consumers believe that inflation expectations are going to rise and gas prices are going to rise, sure enough, gas prices headed lower as demand continues to fall. And how do we know demand is falling? Well, we got it in today's Consumer Price Index report. This, now it's head back to Bloomberg, as U.S. inflation broadly slows, a sign of progress for the Fed. But the real question here is is this actually progress for the Fed, or is this really just a sign that demand is slowing down? And that's something that even central bankers struggle with. They look at the price index and they want it to normalize down to 2%. They don't understand. It's a sign of supply and demand. When supply is too small and demand is too great, consumer prices rise. So rather than focus on getting supply up, which is what the Fed should do, even though they have no ability to do that, they're bringing demand down. Of course, that's going to have a major effect on retailers and the labor market, as you'll soon see. The so-called core consumer price index, which excludes food and energy costs, the part of the CPI that the Fed is currently fixated on, increased 0.2% from September. The economists favor the core gauge as a better indicator of underlying inflation than the overall CPI. That measure stalled, restrained, as we've been telling you, by cheaper gasoline. So it's amazing that, of course, we show you that chart, and sure enough, what do we see in the data? The consumer price index came in completely flat. And here, month over month, 0.0% growth. The core slowed to 0.2%, suggesting that a continued slowdown in core CPI will keep the Fed on ice. And look at this, the year-over-year rate of change in the CPI index dropped to 3.2%, this from 3.7 last month, moving steadily toward the Fed's target. Even the core CPI slowed down. The advance in the core measured reflected increases in rent, motor vehicle insurance, and recreation. Again, some of those will be transitory, particularly in the rent and motor vehicle insurance space. It was also partially due to a methodological change in how the government calculates the cost of health insurance. It rose 1.1% in September. Now I can tell you I just got my renewal, and many of you who are on self-employed plans or on Medicare plans are in that open enrollment period. You're seeing your prices rise here, but again, that will moderate at some point. Notably, we'll see car insurance and rents start to stabilize, but that still tells us, as we look towards Home Depot now, that the worst is yet to come. As Home Depot warns of more weakness ahead in big ticket pullback, as same-store sales are expected to drop. And wait a minute here, we've been told that we're going to see a kind of resurgence in the economy, that a soft landing, that the labor market was going to hold up, and the spending was going to drive us into a new bull market. Well, Home Depot is saying it doesn't look like that's going to happen at all. While customers continue to spend on small projects, big ticket purchases are under pressure, a sign that consumers have less money. Same-store sales, a key measure of retailer performance, will probably drop 3 to 4% this year, which is not a good sign for the health of the U.S. consumer, which is trimming 1 percentage point off each side of that range. Earnings should fall as well, and we know when earnings fall, well, that means stock prices usually do as well. An average ticket, the dollar amount spent per transaction, fell from a year ago, suggesting that inflation is no longer propping up Home Depot's performance. And that was something that was really important for all of these companies. Higher prices lead to higher wages, lead to higher revenue, higher earnings, higher profits, and now it's going away. And here we see narrowed guidance welcome here, considering cuts for fourth quarter. Elsewhere in retail, this is going to be a big issue because cuts of what Home Depot is not telling us is that means layoffs are coming. Here we can see advanced retail sales in blue shown on a year-over-year rate of change against the 4-week moving average of initial claims. And sure enough, when retail sales slow down, well, you need fewer people to sell your stuff. And notably, that means the 4-week moving average of claims rises. We see that almost identical times happening. We saw it here again just earlier this year. And what's happening now is we see a bit of a bump in retail sales as that starts to roll over, which we're seeing signs from Home Depot that it is. That look for that to mean that initial claims are indeed headed higher. But one thing we also think is headed higher, and that is the stock price of our sponsor for today's show, Avicanna. Let's check them out because they're driving biopharmaceutical advances of naturally derived and evidence-based products. You can find them on the TSX under the symbol AVCN and on the OTCQX under the symbol AVCNF. And as always, you can find all their information in the pinned comment and description below. Let's check out what's going on with this company and the case we're making that their stock price could move as much as 34%, because this is a company that's got a bunch of news coming in the future, and you want to follow them along with their stock price higher. And here you can see that what's going on with this company is they are a Canadian international commercial stage biopharmaceutical company focused on the advancement and commercialization of evidence-based cannabinoid-based products for the global medical and pharmaceutical market segments. Avicanna has established scientific platform, including R&D and clinical development, that has led to the commercialization of more than 30 products across 5 market segments. And let's take a look, and more specifically, at their stock price and some of those markets that they're impacting in a big way. And here you can see, looking at their chart, we're on a 2-year daily chart now, and we can see their stock has been in this long accumulation phase for almost 2 years now. And what this means is buyers are stepping in, and you see these purple lines. These lower 2 are supply zones where buyers have stepped in at various levels. And notably, look at this. Right here at this red bar, this is a volume profile line sitting right around 28 cents a share, where prices were right around 29 at time of recording. We're seeing a slowdown in momentum on the RSI and the MACD, but if we zoom in, we're going to show you this is looking to bottom, because where this volume profile line suggests is where buyers are at. And when this holds, you're going to get a move up here to the next supply zone. This is where the sellers are at. There's your 34% move up. If it breaks above that, well, sky is the limit for Avicanna. And Shoppers Drug Mart partners with Avicanna to transition medical cannabis by shoppers. This is a big business for Avicanna. Let's take a look at what's going on here, because first launched in Ontario in January 2019, medical cannabis by shoppers provides patients with access to medical cannabis products from more than 30 licensed cannabis brands. Over the past 4 years, the platform has supported tens of thousands of patients and has worked with patient groups to make access to medical cannabis easier. And we're grateful for the trust placed in us by our medical cannabis patients over the years, and we're confident we found the right partner in Avicanna to continue to support them. And as part of this transition, Avicanna will introduce MyMedic.ca, a new medical cannabis care platform designed to enhance the patient journey. And here's what I want to suggest to you. You want to keep an eye out on news for this, because this is a big driver for Avicanna's revenue and earnings. So keep an eye, because we think that what's going on with that could drive their stock prices higher. Here you see, as we zoom into the 1-year chart, sellers above at 35 cents a share. And you notably, when it comes out of the supply zone, it usually jumps to right around 35 cents, upwards into 40 cents. There's your 34% move. And notably, look at what's going on with the MACD. It's starting to bottom, because momentum is looking to turn here to the upside. As Shoppers Drug Mart and Avicanna execute definitive asset purchase agreement, this is now a done deal, and you can see with the final closing date set for July 31st, 2023. This means it already now has happened, and this is why I'm suggesting keep an eye out on the news flow for Avicanna and watch their stock price. Both, we think, are headed higher. And here's the further evidence. We take now look at the 90-day chart. What do we see? The MACD starting to bottom out. We look, even though the RSA did not get down to oversold territory, starting to bounce upwards and bring momentum higher. And sure enough, you can see clearly the supply zone price came down into it, is now bouncing higher. There's your 34% move to the upside. And again, you can find Avicanna on the TSX under the symbol AVCN, and on the OTCQX under the symbol AVCNF. Again, everything in the description below. And as always, with any of our sponsors, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre, still at the hospital here, going to pick Dad up in a little bit, take him home. He's doing well. And with that, have a great day. Bye now.